Hello and welcome to Business Today Television. You're watching Market Masters. I'm Siddharth Zarabi and with me Kenneth Andrade, the founder and CIO of Old Bridge Mutual Fund. Kenneth, welcome. Very clearly this is a time of extreme volatility that we have seen globally. And now, of course, it is clear that while the macro environment remains fluid, it seems that the worst of the tariff related news may have already been factored in and priced in by markets, and President Donald Trump also seems to be softening, particularly vis-a-vis China. Is that the right way to read the current situation?
Uh, all of this will still evolve, so we do not know how directionally it would go. But quite clearly, we are in all the developments that have taken place. It's really a new environment that we are staring at. Over the course of the next couple of quarters, or probably next couple of years, the environment will still be reasonably fluid, and we probably need to take it one quarter or 1 year at a time. So let's see how all of these things emerge. While all saying that, we are not going to be wiser in the next quarter or the next year. But clearly, from a standpoint of where we stand, both the Indian markets as well as the Indian economy, we're slightly better placed than most of the global peers that are there within the emerging markets and also within the developed markets. So I'd just like to lead with that statement and take questions from there.
Uh, that's a good point, and I'm reading what a recent report said from you. You said the macro environment will remain fluid, and at times like this, discussing valuations and stock prices may not be really material. Till the emotions settle, this report states asset prices would at best tend to drift. And for a while, Indian equities, which have been a pricey asset class to invest in, today they seem reasonable. Expand on that. How reasonable do you think Indian equities are looking like at this point of time, Kenneth?
So let's look at it one step at a time, right? I did mention that from our standpoint, we seem to be pretty much placed well economically. I think this 5-6% growth that we are looking at in terms of a real GDP growth, if we be able to achieve that, which I think we will still be amongst the fastest growing economies globally. That's point number one. Two, there were concerns a while back that the market has been unidirectional, and there was a lot of inconsistencies that had surfaced, both with the primary market and with the small caps. I think that has tempered quite a bit. The market's lost that adventurism, and while valuations have not corrected dramatically, they have at least they're beginning to show some level of consolidation, and some of the grossly overpriced stocks have actually corrected quite a bit. But yet the market seems to be some part of the market seems to be uh, quite expensive, which is why I think the best situation for us as investors was expect this consolidation to last a little while. Now, why I say consolidation is because earnings have to catch up with the price earning multiples that are there, right? And why I don't say there'll be an incremental drawdown is because that incremental drawdown, it's a little difficult to grapple with corporate balance sheets or companies being in the best financial health and stock prices coming down. That doesn't happen. Historically, that has not happened. So I think the best way to look at this environment is that the market consolidates itself. It gives a, and which is why don't look at stock prices so much, but just give it time for it to consolidate. Let earnings catch up with valuations, and at the end of it all, this 5-6% growth that we're looking at from a real GDP point of view, economically that will attract reasonable amount of capital. So that's essentially the three pillars around what I think will evolve over the course of the next year, maybe two.
Kenneth, what is likely to happen as far as FII inflows are concerned? The process of finding their way back to India. Where does that stand according to you?
So I did mention that amongst our peer group as well as amongst the developed markets, at a 5 to 6% growth, or even a 5% growth, will be amongst the top, amongst the countries that will grow, among the countries our size that will grow the fastest, or will still lead the growth. So that should attract its own set of capital. India's got its own set of fans out there, and global investors have been looking at Indian markets reasonably hard. They've just been put off by valuations. Now I think that will change a bit. Global allocations will be in our favor for a while. I wouldn't expect disproportionate amount of money to come here. But those who've been on the sidelines waiting for a correction, they've got an element of it also. You'll see bits and pieces of that trade of FIs taking money out reverse itself.
Okay, reverse itself. That's a good point there. I want to take that point forward again by reading for the benefit of our viewers. Very important line that you make from an India point of view. You made this point about India being a large market, and then you say that virtually all businesses out of the West are struggling to relook their supply chains, which are located in China or Vietnam or Far East Asia and Mexico. You then say that we are currently at the bottom end of the food chain, positioned slightly better than most of the other countries around us. Do you think this positioning is likely to sort of crystallize into India becoming a more favored spot for supply chain relocation?
So we are a more favored spot. Let's put it that way, right? To integrate a supply chain into India in virtually all industries, I think that's too much to ask for. We are a services economy. I don't think we can replicate that in manufacturing. I don't know if we have the discipline, or we still have to prove that we have the discipline to put 50,000 people into a factory and get it productive and get it extremely highly productive, that some of our that some of the other countries have been able to establish. Maybe we can do it in one, two, but I don't think we can do it across the board. So that's where that's something that we will struggle with, or that's something that I struggle with, to become the preferred supply chain for the rest of the world in multiple industries. That may not be the case that we're looking at. So we'll excel in services. We'll continue to excel in services. There are some industries where we have a competitive edge. We've seen that in information technology services. We've seen that happening in pharmaceuticals. We've seen that happening now in chemicals, in especially the agrochemical value chain. Though it's still expensive compared to some of the Asian countries in terms of pricing, but we were able to create supply chains in that one vertical. Automotive is the other place that we can do reasonably well. So there are industries that we need to pick and choose from. I don't think we are ready for the rest of it all. I think we're still a couple of years away for all of that to come together. So yes, services will continue to dominate, and there are some individual industries that are there that we will continue to dominate. I think we're already there amongst the most favored nations for a country or two, for Europe, for the US. But to say that we'll put in supply chains into this country in manufacturing, we're still time away from that.
No, that's a very good point, because I'm reminded of what happened in the aftermath of COVID. At that time also, this whole bit of relocating and India becoming part of China plus one, as it was called then, Kenneth, happened, and I completely buy the point that you made. Let's turn to, because you mentioned several sectors. What, according to you, are the sectors that can be described as pockets of value in this current and emerging scenario? And on a sectoral basis, which sectors do you see doing better than others?
So, Siddharth, you'll be able to find relative valuations which are good. I don't think you will find absolute value in the country. Okay, now when I say relative valuation, X sector is cheaper than Y, and that's the way to go to. So when you look at India from a lens, you still have to comparatively look at it from a execution point of view. Now you have to buy a business model. It has to execute well, and then you will find value in retrospect, right? So you're taking execution challenges. You're taking relatively comfortable valuation risk, but you have to take execution risks to deliver that value on the other side. So you got to give this market time. You got to give corporates time to execute. And our fair visibility, I think the fair visibility that investors should give most portfolio managers or most company managers or corporate managers is within a 3 to 5 year period now. Now the time to have patience for your portfolio to actually incubate the next leg of companies that can execute well and deliver real value to investors in terms of how large they become, how big their franchise is, how globally expansive are their business models, how well they can they create their franchise globally and monetize cash flows from all of this.
Kenneth, in fact, we have a chart up on the screen, a global market comparison. And for a moment, I just want you to sort of explain it to the average retail investor. The Nifty being up, the only index in green, if you compare it with the Dow or the FTSE, the CAC or the DAX. Uh, does this is this telling us a story, or is it a reflection of the trade impact being more overseas than on India?
I think you're taking a very narrow time frame. You're taking a month's time frame to explain these numbers, and I don't think you should technically look at this on a 6 month period. I think it will be more balanced, this number.
Oh, that's a fair point. Uh, since we were talking about pockets of value, there are some experts and even investors who ask us questions, and guests like you answer them. And one of those questions that I noticed was people asking, should we avoid the export segment and look more at companies that are domestically oriented in the Indian context specifically? What would you say to that?
Uh, so we've taken another thought process around all of this. Now, if I just put the domestic market in perspective, I think the core sectors are slowing down. While I do say that we will still continue to grow at 5 to 6%, um, a lot of that is already captured with a reasonable amount of valuations. Look, I said valuations are not cheap. They more than discount that 5 to 6% growth rates that we're talking about. Add that to there will be some pockets of deflation that will be there. This is also exacerbated by what the international environment is all about. So when you have low pricing power and you have mid single digit growth levels and fair valuations, not cheap valuations, your return expectations in the domestic environment should be tempered. Investing in the domestic environment should be tempered. There are pockets of valuation which are interesting. Should I say it's at the banks? There's a lot of regulatory changes happening out there, but they have been correcting themselves over the last 3 or 4 years. So that pocket of opportunity exists. Some financial lending businesses in the NBFC space also gives you this opportunity. So that's where I think there are limited pockets of opportunity, but more valuation based. When we talk about the international trade opportunities that are there, and when you highlighted the fact that we get a most favored nation status, I think that's one place that we have to go out and get market share and create a franchise. I think historically, all American brands available in India, the reason why that is so is because those companies went out and started dominating international cultures or creating products for international cultures. And it's not just in India, it's across the world. The Chinese are doing the same right now. And you had Japanese who took out their manufacturing powers and went across the entire world. So I think put all together, you can't scale and become large. You can't go from 4% of the world GDP to 6% of the world GDP if you do not create businesses which are international. And I think that's the logical way to look at it. So, despite the challenges that are there, you need corporates to go out and do it. Today, a lot of corporates have developed the size, stature, and brands and capabilities to do this. So it's our time to go out there and do it. We've done it in information technology. Like I said, pharmaceuticals is the other place that we tried. We're trending there. Automobiles is a big space that we can do with the help of a lot of technology partners that will help us achieve it. And there are some sub segments within it all where you'll find space wherein we lead cost structures across the world. So I have a slightly difference of opinion. Have a domestic exposure, but look for companies that can scale and scale with trying to access 100% of the world GDP.
Kenneth, which would those companies be? And as you have written and said that investing in globally competitive businesses is the way to go. So, which are those in your mind at this point of time?
I think that's already reflected in some part of our portfolio. We've got reasonable amount of pharmaceutical exposure. That is also in the generic space. Uh, we've got um, uh, uh, we've got technology, which is IT services, and there are a lot of concerns around that. But I think the valuations factor in reasonable amount
Yeah.
of the valuations factored in. I mean, if you leave the last 2 days out, the valuations factored in enough all the risks that people were assuming would get captured in IT. There are some very small businesses that are out there, but the largest of those tiny businesses are almost all are of course automotive, and we've proven our capabilities to scale, put in value chains, and be relevant in that market space. Um, the airlines business in India, for the first time, they're looking reasonably profitable. For the first time, we have an element of surprise that we are amongst the cheapest, we are the lowest cost uh, um, uh, service providers globally in airlines, and agrochemicals, another one that we've been investing recently for a while, but uh, we are reasonably competitive. I don't think we are there yet, but we can definitely scale. And as we find scale, I think we'll have reasonable amount of market share that is there globally.
Interesting, you mentioned airlines, and we had brought up Interglobe. Let's bring that up again, because Kenneth, we've done a deep dive into Indigo, and viewers, that story is going to be out very soon. So do prepare to read your copy of Business Today magazine. That will be up and about in just 3 to 4 days. And one of the things, Kenneth, I noticed there in Indigo was that the same formula that they used, single plane, one format, they are now trying to take that global. And just today the management has said that their aim is not just to continue to be the fastest growing airline, but to become basically a great international global airline. You think they can pull it off?
So I look at it as an investor rather than looking at it whether the business strategy will play out. So as an investor now, it's moved from being a competitive domestic play to a competitive regional play, and now taking the risk of taking on the giants in the business. Okay, and that increases because you grew up in a reasonably protected environment. You've been competitive. You ran a tight ship, but now you're getting into a space wherein you will take on competition, and which are fairly well capitalized. I don't think you faced this environment before, and while saying this, you are also reasonably priced. Okay, but they've executed exceedingly well. We still like the narrative that the business has in terms of scale, in terms of opportunity size, but we are a little cautious as far as valuations are concerned.
Okay, and that reflecting in the run up the stock has had. You also have said that we'll continue to expand our portfolio and encourage investors to view any market dip as a chance to refine their portfolio allocations. Uh, you go on to say if investors are constructing portfolios for this decade, we suggest they approach it as we do. So, basis the questions that we get every day, Kenneth, and I get the sense that people are kind of looking at the here and now of navigating the market dynamics. But if there was anyone who were to ask you a portfolio for the next decade, what would you say to him?
I would still tend to believe. I mean, if you ask me this question about a year back, and you ask me the same question today, my stance has not really changed. I mean, if you're looking for to build a portfolio which has got growth, which has got companies which are capable, you have to buy businesses which have demonstrated their ability to gain market share globally, and put together a franchise globally, right? Because at the end of the day, what you're going to monetize in the long term is 100% of addressing 100% of the world's GDP, rather than just 4% of the world GDP, which is India. You have to look beyond your boundary to create those significantly large companies out there. So I don't think our narrative has really changed. And whatever has happened over the course of the last 2 weeks, 2 maybe 3 weeks, opposed to US elections, I think we are in a better. I definitely believe that we are in a better state, better position now than we were ever before to take opportunity of the disruptions out there.
As we wind down the conversation, I want to go back to the macro picture. So, at this stage, we've been 2 or 3 weeks into the tariff war getting unleashed, and there's a 90-day pause for the rest of the world. Within that, several trade deals likely to be signed, but very clearly over the last 24 to 48 hours, the softening towards China seems to be driving market sentiment overseas. At the end of 90 days, if I were to ask you to sort of do some crystal ball gazing, what do you sense is likely to happen as far as the overall trade dynamic is concerned?
Siddharth, that's beyond my domain of expertise. I'm a stock picker. I allocate stocks to portfolio depending upon how I see the environment. And it has to be a rational environment to make money. If policy is undecided, then we will also whipsaw around with the marketplace. And ideation has to be relevant to what the environment is doing. So we think there will be a logical format on how these things will evolve. It's going to be a different world. It will be a world where barriers will come up and doing business will be more expensive. While doing business is going to be more expensive, it's going to remain inflationary. You might have a deflationary impact for a while because of surplus inventory sitting in a few countries. But post that, I am pretty much sure we'll trend back to an inflationary economy, maybe by 2010 or 2026-27 onwards. So that's how we're deconstructing the global macros without taking the political frameworks into place. Irrespective of whichever ways, equities remains one of the better asset classes to invest in over the long term. In the near term, there will be my opportunities in the fixed income side of the marketplace. But once that is done, I think you'll have to flip over back to equities again.
And where
2027,
does gold fit into all of this?
it's done very well till now. I don't know how much you want to extrapolate from there.
Okay.
I mean, the fundamentals of all of this, it's been a brilliant hedge to your portfolio. If currencies are going to be volatile, and you have this, uh, gold can only be a hedge.
Absolutely, Kenneth, and that's perhaps the best takeaway at this stage, to keep a key eye on valuations and perhaps also follow that old adage, as you write, buy when low. Kenneth Andrade, thank you very much for your time as always. Viewers, that was Kenneth taking us through overview and take on which way the markets are likely to shape up in the near future. With that, it's a wrap on this episode of Market Masters. If you've been watching, thank you very much.
These are the faces of terror. Probe agencies have released these sketches of the terrorist. Forensic analysis and survivor testimonies have revealed shattering details. Terrorists used military-grade weapons, suggesting that the attackers were well equipped and well